Ever since the Bank of Canada started increasing the overnight rate in early 2022, we've heard predictions from economists, politicians, and professionals from many industries about when they think the Bank of Canada will begin cutting it again. And despite the Bank of Canada standing firm on their goal of getting inflation under control, and the fact that it can be at least 12 months before we start seeing the full effect of these rate changes on the economy, many were hoping that the rates would be cut as quickly as we saw them increase. But this year has shown us that's likely not the case. And with 2 more rate increases that came in June and July, there's a lot of concern growing around a significant number of mortgages due for renewal over the next couple of years. However, the Bank of Canada made no changes to the interest rate at both the September and October rate announcements, so this has sparked the same conversations and predictions about when the cuts may start, just like the last time the Bank of Canada signaled a pause to rate increases. According to a recent statement from the Bank of Canada's Senior Deputy Governor, it's likely that higher interest rates are here to stay. My name is Jessie McClellan and I'm a realtor here in Oshawa, Ontario, and in this video I'm going to talk about why we may have to get used to these higher interest rates. If you like this video and would like to stay up to date on everything happening in the real estate market, especially in Durham region and the GTA, then make sure you subscribe to the channel. So over the past 18 or so months, we've seen the Bank of Canada increase the overnight rate by 4.75% to where we sit today at 5%, signaling a significant departure from the low interest rate we've become accustomed to over the last several years. And many are wondering, when is the Bank of Canada going to start cutting the rate to bring us back to that level? And the answer may be not in the near future. Although a 5% overnight rate is high for what we're used to, historically speaking, it's a relatively normal rate. When looking at the 10-year graph for the interest rates in Canada, our current level sticks out like a sore thumb, but flip that to a 25-year or longer chart and the low levels we've seen over the last decade start to become what sticks out. The reason we ended up with extremely low interest rates in the first place is because of the financial crisis due to the housing market crash in the United States. It was the worst economic slowdown seen since the 1930s. Central banks across the globe began dropping interest rates to ultra-low levels. In Canada, we dropped under 1%, and it took us over a decade for us to even get close to 2%. Of course, the pandemic came and rates dropped again and would not rise above 2% until last July. So while it felt like sub 2% rates were normal, it was not always this way historically. The rate we have right now is much closer to normal. But this is where things get messy for the Bank of Canada. The overnight rate set by the Bank of Canada helps to inform the prime rate for lenders, and then buyers end up with a variable mortgage rate of prime plus or minus a percentage depending on creditworthiness, etc. And when the overnight rate increases, so do the mortgage rates for those people with variable rates. Now, for buyers who have a fixed rate, those fixed rates are influenced by the Bank of Canada bond yields and changes in the bond market, and then lenders offer fixed rates at the bond rates plus a risk premium, usually between 1 and 2%. This means that when bond yields are up, fixed rates will likely be up as well, and when bond yields are down, fixed rates may also follow. And right now, there are a wave of mortgage renewals on the horizon occurring between now and 2026. These higher interest rates, although not high compared to what we had before 2008, and especially in the 80s and 90s, is considerably higher than the rate those mortgages would currently have. And this leaves a lot of people, from economists to homeowners, concerned about the impact those renewals could have on the real estate market and home prices. But home prices falling due to an increase in forced sales and lack of buyer affordability may not be enough to scare the Bank of Canada from keeping rates where they are for a while or even continuing to raise them. According to Carolyn Rogers, the Senior Deputy Governor of the Bank of Canada, the housing market has been more resilient to rate hikes than historical patterns would have suggested, thanks to a structural lack of supply. As interest rates go up, consumer spending is supposed to go down. However, with the pandemic, many Canadians saved a lot of money, and even as interest rates went up, spending continued. And mortgage interest rates were the largest contributor to the year-over-year CPI increase, both contributing to inflation being harder to reduce. Since the peak of the market and when the Bank of Canada started raising interest rates in March of 2022, the average home price in Canada has dropped 13%, with steeper declines seen in markets like Vancouver and Toronto. So if the Bank of Canada was expecting to see larger drops in home prices across Canada based on historical data, does that mean they won't be changing their stance on inflation and interest rates regardless of what happens to home prices? Carolyn Rogers highlighted that the bank is not aiming for a particular level when it comes to interest rates or mortgage rates. Instead, she emphasized that the primary focus is on bringing inflation back under control. And the Bank of Canada has previously stated that their target is 2%, and their projections show that inflation will cool down to 2% sometime in 2025. It sounds like the Bank of Canada isn't going to give in to any pressure from lenders or struggling homeowners by lowering interest rates. It sounds like they are willing to allow the market to correct or do what it's going to do to get inflation under control. They are simultaneously trying to forecast and balance the risk of stimulating and cooling the economy. And if they keep rates high, they risk a shock to the real estate market, and we likely see an unfortunate increase to the number of homeowners who can no longer afford to pay their mortgage. And if they lower the rates, thereby easing the pressure on homeowners, we could see inflation start to spiral out of control again, making it even harder on Canadians and the economy overall. So is it possible that we don't see rates drop back to where they used to be? At this point in time, it seems very possible that we won't get back to those rates, at least for several years. But that doesn't mean that the Bank of Canada won't cut rates either, or that homeowners won't get some sort of relief come renewal time. It's possible that the Bank of Canada does cut rates, but it will likely be done slowly and in small increments, and it's likely we stay a lot closer to the current 5% than the sub 2% levels that we were used to seeing. Leave a comment below. I'd love to know what you think interest rates and home prices look like next year or in the next 2 or 3 years. Thank you so much for watching until the end. If you'd like to see more videos on our real estate market, check out the other videos and don't forget to subscribe to the channel. I'll see you in the next one next week. Bye.